Like to thank everybody for joining me today. Today, I want to talk about making sure that we're designing the life insurance correctly. There's a lot of options in designing life insurance. And if you think about life insurance, it's like having a Swiss Army knife. It can be designed a lot of different ways, solve a lot of different problems. But the more we understand about the different products, the different designs, the different riders, we're going to be able to help our clients really get the result that they're after. So, as you think about this, start thinking about how we use life insurance and how good of a planning tool it can be. There again, it's not the only planning tool we have, but it really fits in a lot of places. If you start looking whether we're doing tax planning, estate planning, retirement planning, or business planning, and there's other areas here, life insurance is kind of that missing puzzle piece. I work with a lot of clients, a lot of different, size estates and businesses. And I find those that that understand life insurance and the opportunity with life insurance, they seem to get a better result. I look back in my career, especially starting out as a tax attorney. In the estate planning arena, was probably arrogant enough to think, okay, I can help plan, take any client's estate and eliminate the estate tax. Well, I had to put a little caveat to that. I could help eliminate their estate tax if one, the client's willing to plan, and two, if I have a lot of time to get that estate tax down to where it's manageable. When I understood life insurance and estate planning, I realized, hey, that's a leverage tool that, we can use that to solve a lot of those estate tax problems immediately. Same thing in the business planning for buy-sell insurance, retirement planning with the tax-free retirement ability of life insurance. Of course, tax planning and playing the income tax world. We've got a tool that that can grow that value in an income tax-free environment. But there again, we want to understand the different areas that we're working in, but also understand how flexible the life insurance can be as that additional planning tool as we're working with our clients. As you start looking at designing the policy itself, well, we want to make sure, are we looking at this as a max death benefit? And typically when I'm looking at max death benefit, it's max death benefit for the least amount of cost. We're not worried about growing cash value here, even though cash value might be an element of the illustration. That's not the goal. We're looking at this because we want to pay off estate taxes, have estate liquidity to pay off debt, buy out a business partner, equalize distributions to the kids, provide for a special needs child. All of these things require death benefit. That's our goal. Now, when we start looking at reducing that to a max cash value, so maximum cash value means we want to stay minimum non-MAcc design on the policy. Well, that's great because now we're reducing those costs, and mortality cost is by far and away the biggest cost of the insurance policy. So if we can reduce that death benefit down, we're going to be able to maximize our cash growth. One of the things that I hear quite a bit, well, can we do both? And for some clients, that may work. I was talking to an individual the other day and I just said, hey, you may have two different goals here. One is a max death benefit, one's max cash value. Let's do two policies to solve two goals if that's what we want. But understand we need to know what we're looking at to make sure we get the right fit. If you start looking at the rest, what insurance can do, well, number one, we have an income tax-free death benefit. Now, yes, that can be messed up. There's a few rules that we just don't want to violate. Transfer for value as being one of them. If as long as we've designed that policy minimum non-MAcc, we can get that policy not only income tax-free for the death benefit, but we can also get the money out during life and distribute cash value either through distributions or loans tax-free. Now, if we wanted estate tax-free, we've got to take that extra step to get it out of the estate and make sure we don't have incidents of ownership that will bring it back in. What I really like when I'm looking at the cash value and accessing cash value, we can access that cash at any age. Now, we're always looking at, well, okay, can we access it before age 59 and a half? Yes. If you need it, let's teach our clients to use this as their line of credit. Take money out as, borrow it out, put it back in when you don't, when you're ready to pay it back. You can start using this policy at any age. But also the flip side, if you don't need the money, if you don't need access to that cash, we don't have required minimum distributions that are forcing us to use the money that we don't want to take out. So it becomes that very flexible planning tool throughout our client's lifetime. There's no limits on contribution amounts. I get this quite a bit. Well, how much do I need to put in? Well, how much do you want to put in? What's appropriate to put in? So we're going to design the policy based off of what our client wants to do, not any, maximum or minimums that's being forced on us by other tax provisions. So it really allows the client to, make this flexible for them, make it usable for them. The big thing going for us now are all these additional riders. And I think that's the growth of our industry with life insurance. I think the companies are going to come out with better riders, probably more riders that allow us to do more with the policy. And I like this, especially when you think about a mutual company. With a mutual company, the policyholders are the owners of the company. The company's finding ways to help their owners use their policies better, more efficiently, and whenever they want. And that's what these riders are going to do for us. One of the things that I see as an issue, and we want to make sure we address, is when we're using life insurance inside of irrevocable trust. So we all know irrevocable life insurance trust, ILITs. So we've got to make sure that when we're designing the policy, that the policy fits. So when we're looking at that insurance design, we need to look at who should be the owner of and beneficiary of that policy, and B, is the policy designed correctly? So if you look at this, and I just, have husband and wife, setting up an irrevocable trust. So husband in this case is setting up the trust for his wife. Husband will be the grantor, and the policy or the trust will be set up for the wife. What I like about this, if it's structured properly, that's outside of the taxable estate, it's asset protected, doing exactly what we would want that irrevocable trust to do. Now, if we look at that trust, we're going to create a lifetime beneficiary if we're doing this for spouses. And we can add the spousal lifetime access provision. What does the wife in this case have access to? All of the income and principal inside of that trust. So those assets can be used, for the wife's benefit during husband's lifetime. So as long as the wife is alive, she's going to have access to this as much or as little as the trust, provisions allow. So we can restrict that or expand it out to be fully flexible. Now, the concern is if we have a life insurance policy. Now, the benefits for the wife, the policy would be on the husband in this case. And now we look at that policy. What features and benefits are we looking at here? Well, of course, we can go in and say, let's put a death benefit here. Maybe it's a large death benefit, maybe it's minimum non-MAcc death benefit. But that death benefit is there when husband passes away, the wife is taken care of during her lifetime, either through, access to the cash value or as a death benefit when the husband passes away. Now, remember, we've got all of these riders. This is where I want to caution you is when we're adding the riders for long-term care or chronic illness riders, and we're holding that inside of an irrevocable trust. Now, with those riders can be either an indemnity benefit, where the insurance company just says, here's a check, use it any which way you want, or it can be reimbursement. If we want access to this, if this is a selling point for the client, we want that long-term care or chronic illness rider to be an indemnity benefit, so we can actually trigger the benefit, get that benefit cash inside of the trust. And the wife at that point can take it out, use that for her husband's care. If it's a reimbursement policy, we would never, ever be able to use that. So just something to be aware of. We'll talk more about that in detail over time, but just be aware when we're using a truss, we want to make sure that we're designing a little bit better and making sure it all fits. So I appreciate everybody getting on. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.